Tonight, revised job numbers shock the market, rates wobble after hitting 2025 lows, and don't fall for the Fed. Cut myth, why mortgage rates won't automatically drop when or if the Fed cuts rates. That's next, before the headlines.
Welcome to your weekly Mortgage Minute with your favorite AI twin, John Hopkins, the Mortgage Navigator. And now, John Hopkins.
Good evening. I'm John's AI twin with Anchor Mortgage, your mortgage navigator. Today, we're running a special Tuesday update because the tide just turned and we want you anchored in the truth before the headlines hit.
Rates are still near year-to-date lows, but we've lost some ground after yesterday's bond rally cooled. The 10-year Treasury nudged up to 4.065%, reversing part of Friday's post-NFP drop. The shockwave? Annual revisions to non-farm payrolls, down 818,000 jobs. That's like realizing your ship was missing half the crew you thought you had. Markets hate surprises, and this one just changed the narrative. The labor market is softer than we believed. As of this Tuesday morning, conventional are hovering around 6.28%, which is a slight improvement. 30-year FHA at 5.9.4%, and VA at 6.01%. Again, all still near two-year lows. Important note, as of recording of this video, mortgage-backed securities are down 1/8 and growing, so there is an elevated risk for a midday reprice or seeing some softness when the markets open tomorrow and lenders generate their rate sheets.
Closer to home, the tide is shifting too. Virginia Beach homes are still moving quickly, but Norfolk's seeing nearly half of listings cut prices. Chesapeake has homes, but they're sitting the longest, carrying the most inventory, while Hampton and Newport News are steady around the mid-300s with about a month on market. Bottom line, homes aren't flying off the shelves. Price cuts and seller credits are keeping deals afloat.
So let's break it all down, navigator style, so you know what this means for you. This is the storm that's brewing. Everyone's waiting on Powell like he's Santa Claus, convinced mortgage rates will fall the minute the Fed cuts. Buyers are waiting, sellers are stalling, refinancers are holding their breath. This is the anchored reality. Mortgage rates don't follow the Fed funds rate. They follow the 10-year Treasury and spreads, and those markets price in expectations ahead of time. That's why we're already near 6.3%. When the Fed actually cuts, rates may even rise if the move is smaller than markets expected. And here's what it looks like when we reach calm seas. Buyers, you've got leverage with over 40% of homes nationally seeing price cuts. Sellers, you can still win, but credits and buydowns are your sales. And refinancers anchored above 7%. Today's waters are your chance to save big. The calm isn't after Powell speaks. The calm is right now. For this week's Navigators recap, jobs revised down 818,000, which shows labor market weaker than headlines suggested. Rates dipped to two-year lows, but bounced back a bit today, although still in low sixes. We busted the Fed, cut myths, so don't wait for Powell. Markets already pricing expectations. Hampton Roads, more inventory. Longer days on market, sellers using incentives. All eyes on CPI Thursday. This is the biggest anchor event for rates this week. I'm John Hopkins, AI twin with Anchor Mortgage, your mortgage navigator. Stay steady, stay confident, and most of all, stay anchored in the truth. And hey, if this helped you make sense of the market, do me a favor. Like, share, and subscribe so more people can navigate these waters with confidence. It helps me keep turning market chaos into clarity for you every week.
Oh, if you need help, guidance, or just want a navigator by your side, we are always here to steer you in the right direction. Reach out anytime. That's what we're here for.